Good day, Market Chameleons and everyone joining the show. Welcome. Before we get started, let's look at the shared disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all our webinars and shows, are for informational purposes only. Before we get started, take one last look at that disclaimer, and let's welcome Dimitri Pargamonic to the stage, and we will be discussing how to run a custom options theoretical value model today.
Yep. Good morning, Will. How are you?
Good.
Good morning, everyone. I'm going to share my screen here. And what we'll look at today is, let me start out from the main page, is how to run a theoretical value options model or theoretical value model, but we want to change some parameters around to see, well, if we narrow our data or expand our data, because whenever you're running a model, well, you have inputs, right? You input into the model, and then you get an output, and then you have this result to analyze. So a question came up, and I think that I'm just going to review, some of these parameters to help, answer a question that I got by email, but it will also help, everybody else out there using the same tool. So let's take a look at a stock, and I'll bring up Merck. So let's say MRK. And I'm going to go to the options chain. So this will take us to the main summary page for Merck. And on the left-hand side, we have this menu. And what we're going to do is go to an option chain. And within the option chain, we're looking at these different prices, right? Let me click on this menu to minimize and expand our screens. And when we look at an option chain, well, we got all these different options with different option prices. Well, what's a quick way to kind of analyze or evaluate are these prices on the high end, low end of the historical range? So when we're looking at financial assets, we're trying to compare the prices to a benchmark to see, how far away are the prices from, perceived or theoretical values. So think of it as like, if you're trying to if you're a real estate investor and, you have, properties, in this neighborhood or in that neighborhood, and, properties that are, this square footage or that square footage with pools, without pools, like, well, you got all these different prices and how do you evaluate which, put in a value on each one to compare how far away those prices are. It's an important aspect of doing your analysis. So when we analyze these options or even strategies, one way to compare the prices is to create a benchmark and see how far away are we from that benchmark. And benchmark is created through some kind of a model using data. So let's look at the one that came up was something like, here's Merck expected to report earnings July 29th. So let's say we're looking at an option that option expiration that falls after July 29th. Let's do like August 15th. And how do we look at these option prices and run a model? But, the model has to consider that there's an earnings event coming up, right? So that's an important piece of information, because if we're looking at option prices, well, option prices that cover earnings will be valued differently than option prices that don't cover earnings, right? Because earnings is an event. It's an event that we know historically is a binary event. The stock has a different volatility and it gets repriced because there's new information that hits the market, the stock gets repriced, and we know that this earning is coming up. So we're going to put a different price on options that cover earnings than don't cover earnings. And that makes sense, right? That makes sense with lots of stuff in the economy. Like think of like where, we know that, it costs more to fly certain times of the year because there's a higher demand than other times of the year. Like maybe when the holidays, for example, people travel and kids are out from school and families go, so the prices are higher than their like times prices are lower. And Super Bowl tickets cost more money than a regular ticket to like the first game of the year. So we know that there are certain times when things get priced differently, and we have to take that into account in our analysis. So let's take a look at a strategy, right? Let's say we do this strategy. Let's set up a straddle. So the stock in Merck is like around $84. So let's say we're trying to analyze this straddle. So I'm going to click on the call ask. So this is the call 84 call on the side. So when I click on the ask price 325, it creates this ticket for analysis. So it says, okay, we're gonna try to analyze buying a call, and we're gonna use this current price 325. So that's what we're analyzing, because when we're analyzing an option, we're looking at the market price, right? Is the market price high or low? But we were doing a straddle, so now we got to go and do the other leg. So let's say we go to the put, and we click on the ask of $2.77. So now here we go. We have these two options: buying the August 15th 84 call for 325, buying the August 15th 84 put for 277. We could change these parameters if we wanted to, but let's leave it as is. And we're going to run this analysis. And when we run this analysis, we get these like quick theoretical values, right? So these are like kind of quick reference prices that we have preset based on the default parameters. And the first one, it's using a model of historical stock return distribution. And what this does is say, okay, based on historical stock moves, given similar situation, right? What is the average end value of this straddle? Okay, that's what it's looking at. So what's the average end value of the straddle? So it says $3.45. So now we could compare that to the market price of 602. And then we got these historical win rate and probability of touch. And these are also looking at, well, based on this market price, historically, how often would the stock, did the stock move enough by the end to make this price profitable, 602 from the buy side? That was 19%. So this is comparing it to historical data. And probability of touch is, well, how often did the stock move at any time in between, to expiration, because it has this strategy, it has 16 trading days, 22 calendar days. Historically, over that time period, at any time, how often did the stock move to, justify this price from the buy side? That was 44%. This model here, that looks strictly from how were historical options priced, so ignoring how the stock, because maybe the stock moves at a certain volatility, but maybe the options tend to be, a little bit higher priced or lower priced than the actual volatility. So this looks at the implied volatility, because of the options and says, well, historically, if we used the implied volatilities of similar options with this scenario, what was the average value? 569. This is the median value, and this is the high and low range. So now we see these, but this depends on the data we're using, right? Because that's the key here. Are we using 1 years of data, 2 years of data? Are we using data that covers earnings, that doesn't cover earnings? Because the results will be different, right? Any model, right? What is a model? Models, you input something and then you get an output. Well, whatever you input in there, you're going to get, you could get a different output, right? So let's see first, coming over here, and we're going to go to this one, stock return distribution. Let's say we click on this. And this goes deeper into the model. So this repeats the statistics on our data. This kind of gives us the graphical view. But down here, this shows us the data that we used, right? So there's 16 data observations. And you could see here, there's 16 going back because it's looking for historical earnings. So you can see here, April 24th, there was an earnings, February 4th, October 31st, July 30th. So what happened was the system picked up that, well, wait a second, we've got an earnings here, July 29th. So August 15th is an expiration that's going to cover earnings. So given that, we have to, what the model is doing is removing the data that did not have an earnings impact, because that data, right, may skew our results, because we know, like, well, when there's no earnings, we don't typically see an earnings impact. You're not going to see that volatility. So if we're putting in data points that are going to skew our volatility too low, we might not get a good analysis. So it's going to remove that and then say, now bring me the data, the historical dates, right? So we could see here that have earnings. So you could see here, this earnings was April 24th. So you could see here what it did was say, okay, well, go fetch me data, historical data from April 21st to May 13th. So you could see that, well, why this date range? Well, because keep in mind, right, we have a date range here, right? Today's July 25th. We're talking about August 15th. And then the earnings falls, in between there, right? That's what's happening, right? The earnings are falling in between those dates. So what we did was go and find a similar range, right? That find me something that, if April 24th, so we're starting 4 days before and we're finishing May 13th, which is what it's creating a similar range historically for what we're trying to analyze, right? So that's what it's doing. And it's going back and doing that, back 16 observations, and that's because we only have 4 observations a year. And it's going through all this analysis. So you can see here for each one, these are each observation, and then that's the summary of the stats, right? This is the average of all of them, and these are the percentages. Now, what if we wanted to change that? What if we wanted to change that? We could open these parameters, right? We could say, well, let's go 10 years back. Let's see how that changes it. So if I change this, go 10 years back, reloaded. I'm sorry, the current price didn't change, but the theoretical value, win rate, and probability of touch did, right? Because the current value is the current value. That's what we're analyzing. What if we went 1 year? Let's say only 1 year, and we just wanted to look at the last year. We've rerun that. Now we got a different theoretical value, different win rate, different. And then you could see there's only 4 observations in our analysis. So this gives us the ability to run different scenarios, to see just how consistent those theoretical values are. What are the current? What if we used more recent data? What if we use larger data? And it lets us look at it from different perspectives, because there's no one right way to evaluate. There's no one correct set, or there's no exact data points that we could say this is the exact data points we use to evaluate it. We're looking at a model and trying to put different assumptions to see how that changes our theoretical values, and how that changes, how far comparison to the current market price. Now, I'm going to go back to 40 years, let's say. This here is using a dynamic IV range, but I don't think this will only apply when you don't have an earnings impact. What this will do is say, okay, there are no earnings right now, so we're going to use the historical data that excludes earnings periods. Okay, but we also know that we kind of go through high implied volatility regimes and lower implied, right? So sometimes we can move around, like maybe summer months are lower, maybe other months are higher, maybe there's like just high volatility periods where there's something going on, there's low volatility periods. So what this does, in addition to look at historical data, by default it says, well, if we're in a lower tier, let's say 1/3 the current implied volatility, fetch me that data. If we're in a higher tier, fetch me that data. If we're in the middle, fetch me that data. If you want to look at all the data, you can just change that, say use all results, or you could use a custom IV range and say, well, show me data where the historical implied volatility was between this and this, right? So, so right now we have between 14 and 54, you could slide that around, or just all results. I'm going to keep it on dynamic. And here you could say, if there's earnings, by default, it says show me only earnings periods. If you want to include everything, include earnings periods and non-earnings periods, then you could click on this. But if you want to try to stay as close as, your data sets as close historically to what's going on here, it's by default only earnings periods. In other words, if we're looking at an option that covers earnings and it's fetching data that only will include earnings, exclude the other ones. Here it's saying that if there's a period we know of that we're looking at that does not include earnings, right? Let's say that earnings is over, and now we're like, the next month there's no earnings. So by default, this will exclude historical data points that would have covered earnings, right? So we take that data out because that data is going to skew. But you could change that if you want. You could say include earnings. I want to include everything. Okay, so you have a parameter for if we detect there's going to be an earnings, and a parameter if we detect that there's not going to be an earnings. By default, it adjusts for you, but you could change that. Okay, so you could change the year, you could change the data based on where the implied volatilities were historically, and you could change the parameters for earnings and non-earnings options. Now, let's say you've selected this, and you're like, well, this is what I want every time across the board. Like I want always 6 years. I want always dynamic, or I always want, all results, right? And I just want this to be my setting. So when I move from, from different stock to stock, I don't have to keep, changing these. So if you do that, just click on change these parameters and then click on this save as default settings. And once you do that, this will be applied to everything across the board. So if you put in 1 year here and save it as default settings, you close this. If you go on and then you want to analyze Google, it'll be set to one year unless you change it. Okay, so you kind of apply it across the board universally. So that's how these work. Okay, so I'm going to collapse these, but this is where you go. You go to the distribution Theo, you open the distribution settings, and this is where you could control them. And then if you like a certain, parameter that you want to just kind of, start out with in your analysis, click it as save as default settings. All right, well, I'm going to stop right there. I think I covered that question, hopefully.
Yeah, that's a great feature, D. Actually, lots of comments from Market Chameleon regulars who were saying that they have to rewatch this because it was so helpful. These videos stay on the Market Chameleon YouTube channel. You can always go back and look at them and watch them and share them. Remember, always thumbs up and like us on that channel. And follow us on all the social media platforms. Great job as always, D. We will see you Monday next week. I will be in Lake Placid, so I'm almost 100% sure I'll be able to do it from the hotel all week. But you never know when you're in a new environment. But we will try. And if you get an email from us saying we can't do the show, it's because something has happened on that sense, and I will attach a video, a pre-recorded video to that if there is a problem. But great job, D. We will see you on Monday.
Thanks, Will. Thanks, everyone. Have a great weekend, and hopefully we see you Monday.
All right. Have a great day, D. Bye. All right, everyone. Thanks for joining these shows. As always, thanks for all the great comments in the chat. Everyone have a great weekend. Remember, the thumbs up are always appreciated. So you give us some thumbs up on YouTube. Have a great day and great weekend, everyone. Bye-bye.